magnet in this case, is hard. And then last week it was like over and over, stayed over it all week, and then Friday gave it up. Before Friday, I was like, God, this thing's going to prove me wrong, or it's going to go up and break out, and it still could, because you're still hanging up here. But that's the thing about neoclassical. It's like, you know what it should do. It doesn't mean it will do it, and if it doesn't, it tells you something. I mean, this whole move up, when you got over this area here, right, this area, and then here, when you got over that breakdown bar's high, that told us, because this to me was the short area, it told us, okay, well, it's stronger than we think, and if it's stronger than we think, then we've just got to assume that it can continue going. Well, it comes back, it tests, and then sure enough, it goes up and tries to do it again. So if it fails up here, breaks this low, of course, it will all be a big range again. Yeah, it is. And again, though, I think that the most important thing with volume is, some people place so much attention on volume, and I used to. But what I've learned is it just decreases the probabilities a little bit, not that much. For example, when you have a suspect trend versus a confirmed trend, it differs depending on what the time frame is, what the direction is. But we're only talking 2 to 5% at most, depending on which one it is. And so, the percentages are a little bit lower, but that doesn't mean it's going to fail. And that was the point I was making at the top of the show. Is like, just because it doesn't have the volume doesn't mean it's going to fail. It just means its probabilities are not quite as high as it would have been if it had the volume. And so I try not to get hung up on that anymore, whereas used to, I did get hung up on it quite a bit. And I used to, lose trades thinking that the volume was the tell. And it's really not just the volume, it's just a small piece of the whole pie. Max is in? Okay, cool. Alright, I'm going to pick it back up here. So, we were talking about retest, regen. And matter of fact, since I'm on this chart, I'm on the S&P 500 now. I want to talk about, I've got it on the weekly. If you had been around long enough, you would have heard me when we were coming up on this bar here. You would have heard me tell you that that we were going to have a hard time breaking above this bar, and at least that was a significant bar. And it was a wide price spread, and there were two wide price spreads. If we take the top of this, and these are weekly bars now, mind you, if we take the top of this bar is 2100, basically 2103, and the bottom of the next bar is 1867. So 2103 down to 1867, that's what, 240 points almost? That's a huge move, right, in two bars. That zone that it represents, the top and the bottom, that zone should be, or should hold price for a long time to come. And that's in fact what is happening. And so that whole range from this 1863 up to the 2103 is the key zone. And right now what you're doing is you're seeing the test of the top, the test of the bottom, test of the top, a little pullback, another test of the top, and if they can't get it over this area within probably the next 2 to 3 weeks, I would think you're going to see it just come all the way back down again, right, and test at least into the middle part here again, and potentially all the way to the bottom. Eventually, at some point, we're talking about weekly, at some point we will see one side or the other break, and when we do, you can expect a range break extension. And I'll get into that, but essentially it's, and let's get Chuck back in here, it looks like. Hey Chuck, you want to go on mute for us? Alright, great. So if we think about the range that's here, when it finally breaks, right, the top being about 2103, the bottom being about 1860 something, when that finally breaks, you can expect that 240 point range roughly to expand again. Now, to get a break means that you have to get over it, you have to stay over it a bar or two on a weekly basis, and then that would give you the confidence that you're probably going to get the breakout. In this case, because you actually had all this consolidation over here, I really would want to see it break over that area and stay over it as well, because the range may be these tops, but clearly this is a significant. These two bars here are significant, and they're defining a lot of the price action right now on this time frame in terms of the big ranges in effect. Okay, so let's go back to my notes here. So I've talked about breakouts. That's where you get, for example, here's a good example. A swing point high, let's take this one. This is a swing point high, and that's the November 2nd bar. And then you got another swing point high over here, the April 18th bar of 2016. Friday last week, it was over both of those. Those were going to be breaks of swing point highs. That would have transitioned trend. Trend currently is sideways. You see it here with the most recent arrow is your trend, and that's sideways. If it were to get over those and stay over it, has to close over it, that would transition your trend. If you close over just one of them, it would change you to bullish. If you happen to close both of them, you would take the trend change of this one, that would be the first transition, and then you take the trend change of the one prior, and it's actually the highest one. And it is, if you're doing multiple swing points, it's going to be it's always going to set up this way. This one's going to have this one's going to be higher. Let me think about that for a second. That's not quite true. Most of the time that's going to be true. In other words, this one could have had a peak that was a little bit higher, but actually close up underneath this one, and then these two would still be active swing point highs. But most of the time you're going to see it this way, and so the algorithm is you get over it, you stay over it, you look at the trend of the lowest high that it broke, and then the next highest high, and if there's three of them, you go look at the next one. And then that's what gets assigned at the very end in terms of whether it's a green arrow or a red arrow on it, and it would be an up arrow at that point. If it gets over them, stays over them. If it doesn't, it's a test failure. So let's talk about test failures. They come in two flavors. I try to use the terminology test failure only when it does these two things. It gets over a swing point high, as it did last Friday, has less volume on this one, and you'll see I don't round the numbers, but I actually take some zeros off because of the I was on a 32-bit operating system, and 32 bits had problems on monthly charts when you do the volumes. So I actually take and divide these by 100. So there's actually, whatever that is, 1.7 billion versus 173 million, or 17 billion, I guess it is. So that number looks small, but that's really what's happening underneath the covers here. So it's 173 versus 193. So you have less volume, you get over it, you come back under it, you close under it, and it's the close that's important on the time frame you're interested in. That's a test failure. If it had gotten over it and back under it and volume was higher, let's say it was 200, or actually let's make it even better. This was 193.6. Let's say it was 250. That's a lot more volume, right? That would say it's going to try to test it again. It's not done. So that's, even though it failed, it didn't do a complete failure. It only failed on price, not on volume. And when that happens, you have to expect it's going to try to do it again. That's the read. That's the model. Okay, so that's true. Everything I tell you about is true of both sides. Where the lows, like here, was a test failure. This one, the January 18th bar got up underneath the August 24th bar, so it got under it, back over it, failed to stay under it, had less volume, I believe, 266 versus, actually had more volume. So here's that case I just talked about. 266 versus 260. What does that mean? It's probably going to try it again. Takes it a couple bars and then it comes down and does it again. Now it has 254 versus 260, less volume. Even though it does break it, it can't stay under it, and then it eventually gets to run back higher. And you see this time and time again. And like everything else, it's not going to be every time it works, but most of the time it does just exactly what we talked about. You get under it, you have more volume, you try it again. You get over it, you have more volume, you try it again. You get over it, you have less volume, you probably failed. So if I were looking at this right now, odds are this thing has failed and it doesn't have to come back up there and test again. We could just continue down. Doesn't mean it will, but it can. In other words, there's nothing in my model that says it's got to go back and do it again, right? Or when I say go, it has to. I don't mean has to. The probabilities favor it to go back up there if it has more volume. If it doesn't, they favor it not to go back. You know, it doesn't favor it to go back up there. It may or may not. And then you simply, and that's the other thing I haven't talked about. The long-term time frames typically give you the better reads than the short ones. Just like, say, a 5-minute chart, you're going to get a lot of noise. Things are going to bounce around a lot, right? On a daily chart, your reads are going to be more accurate than a 5-minute chart most of the time. You don't have as much noise. Your daily chart is going to bounce around a lot compared to your weekly and compared to your monthly. When you get reads on those other time frames, they typically are better reads. So when I get a read on a weekly, I want to pay more attention to it, like this test failure, than when I get a read on a daily test failure. Now if I get it on both, which in this case I think we actually did, let me pop to the daily chart, then of course they're both confirming each other, and actually I didn't. On the daily, it actually makes sense. It got over them and stayed over them right on the daily, but it didn't on the weekly. So you kind of got the false reads here. In other words, you got to new highs, you come back. Not false reads, they were actually breakouts, right? And here's another thing I haven't talked about. You see these two arrows here saying it broke a swing point high? Well, this one, which is June 7th, broke the swing point high you see here on April 20th. What did this one break? June 8th. We don't see anything over here. Well, the programs keep track of what's really over here that you don't see because we only show 60 bars. And so it really broke a swing point high that's over here that you can't see. How can you tell what it broke? Well, you can actually do that. Let me show you that real quick. If you go to the Trading Cube and you put in GSBC, I can't see my keyboard. Wait a second. Here we go. There's a matrix here that tells you what got broke. And so you can go back and see what it broke, what date it came from, right? They're all here. And you can sort these things, right, by time frame, whatever you want to do. Same thing here, we'll get to these. These are your support zones. So those green zones and red zones you see on the charts, these give you those. The key thing here is the ranking. So if I look at time frame and I take the short-term time frame, which are these down here, I can see that this one has the highest weighting. So this one has the highest value to me, and that zone is from 296 to 2085. And if I go back to the chart and I'll pull up the chart, actually I'm going to pull it up here so I don't get too many windows because that seems to be a problem. 20 GSBC, and I think I said 2086 to something. That little zone that's there, right up at top. That one has more weighting than the blue one, the green one's down here. Okay, so where does the weighting come from? That's probably your next question. That has to do with the types of bars that were used to create the zone, which actually is a segue into the next part of the show here. So anchor bars. Now I'm going to flip around. These are things I can flip with. That takes you down to page 7. So if you're following along in your document, I'm on the bottom of page 6, page 7. So what are anchor bars? Anchor bars are bars of significance. They're, Neoclassical is built all around this concept of significance. What does it mean to be significant? Think about it this way. Let's pick a bar. Here, how about this bar? May 26th. You see that little bar inside this bar prior to it, May 25th? That bar has no value. Doesn't tell me anything. That bar has no significance. I'm not ever going to look at that bar again. Once it prints, it's like forget it, right? There's just nothing there of interest. There was no battle fought. There was nothing that happened there that you want to pay attention to. Okay, so then that begs the question of what is important. Well, what I did when I did all my research is I realized that there was two things that looked very interesting in the charts. And one of the reasons I keep this to 60 bars is so that I can calculate those things of interest automatically every night. What are those things? Wide price spread. Wide price spread simply means that if I take this bar here, which is March 29th, if I take the bottom of the bar, in this case 2028.31, and the top, which is 2055, and I subtract the bottom from the top, I get about 27.6 points. Okay, so it moved 27.6 points. Now, because I've traded futures and stuff, S&P for so long, I can tell you the average range is about 17 points. So this one traded way over 17 points, right? Almost 40% more. If you look on this chart, there are going to be several of these. Here's another one, there's another one, here's one in the middle, there's, you know what I mean? They're scattered around. What the program does is it goes and looks at them and it says, okay, calculate all the wide price spreads bars from today's bars 60 bars back. And whatever the biggest bars are, order them in size and take the top 6. It only takes the top 6. Why do we take 6? Well, because too much information is worthless. You want to narrow it down to something, and so you have to figure out, how much information can I handle on one chart. All these blue bars you see, the solid blue and the ones that have a blue outline, like this one on May 10th, those blue bars are significant bars in that they're anchor bars, and they're either wide price spread, high volume, or a swing point. And they can be multiple things. They can be high volume, wide price spread, and a swing point, for example. In this case, let's see if we can find one that's all of them. Like this one, this was not all of them. I don't see one that's all of them. So the best case here is 2. Like this one is 2. High volume. And I'm going to just try to see here. Yeah, it looks like that one's probably a high volume. And I'm looking at April 20th tonight. That one is high volume, high volume, and an anchor bar. So it gets more points, so to speak. And so when I do the calculation on the zone, if this anchors that zone, which it does, in this case, the low of this bar is the top of the zone, the resistance zone, that's going to get a higher weighting than other cases to where something anchors it that doesn't have as much significance. And so we kind of give significance to the zones based on the values or the significance of the bars that make up the zones. What's the other type of bar? We've got wide price spread. We also have high volume. Well, that's pretty simple. You just take the highest 6 volume bars on the 60 bars from today's bar back, and you take those 6. Those are high volume bars. They become anchor bars. And then the last thing you do is you take swing points. Now swing points, there can be more than 6. In this chart, it looks like there's 3, 6, 9, I don't know, about 11 of them. The dailies you'll have more than you do elsewhere. So you've got, now you've got about, 13, it's about 22 things of significance on this chart. As we go through and the chart continues to change, you draw back on these things of significance to give you areas to test into and to release information on those tests. And one of those things, if you watched the notes this morning, I talked about this bar right here in the middle, May 10th. I said that we probably try to do a test of this bar At first I didn't think we would just get in. Actually, it was on the weekly report that I did this weekend. I thought it would test into this, and I didn't think it would get deep into it. Why was that? Because it had not been tested before. Remember I said 6 bars from the breakout? None of these bars from May 26th forward until yesterday had tested back into this. So that was way more than 6 bars before it came back. As it came back, the probability of that holding, that retest regen off the high and low of this bar, probability is about, I think it's about 90 something percent. Is it that high? I don't know. We'll have to look at the notes. It's in the notes and we'll get to those later. But it's a fairly high probability. So in other words, when you come back the first time after a breakout and that area hasn't been tested yet, it's more than 6 bars, probabilities are very high you're going to get a bounce out of there at the worst. Or you're going to get continuation, regeneration of the trend. So this is a bullish regenerate zone. You come into it today, you almost get to the lows, and by the end of the day it's a draw, right? That's what the doji is. It's both the winners and losers are about the middle, the bears and the bulls. So this potentially dojis can be turning points. We may have a turning point here today. Maybe the Fed's gonna get people excited again for a couple of days, get a bounce out of here. That's what you would expect. If it doesn't do that, if you don't get back over this high and try to push up higher, that's a sign of weakness. That's a precursor to potential more weakness coming. If you do get up here and you continue on up and you get back into the previous one, that's going to be the next place that you want to look. And so you're always looking for the next spot. So in other words, if I get over this high, where's the next place I have to be considered? Well, there's an area between the low of this high and the high of this wide price spread high volume bar. Actually, there's one that has all three: high volume, wide price spread, and anchor. That's a fairly significant bar. And matter of fact, that one was tested today. The low of it was 2071, and we got under it today and back over it and stayed inside of it. Didn't break it down, and I even missed that. I missed that bar's significance. I was focused on this one, the May 10th instead of the April 28th bar. But now that I'm talking to you, I'm seeing, hey, that was a significant bar. And matter of fact, it tested it and held, which gives me actually a little bit more confidence. I'll probably talk about this on the show tonight, that this thing's probably going to try and bounce, which is kind of what I thought it would do anyway. Where's it going to go to now? Well, the top of that bar is going to be a tough spot to get over, right? That's a measuring stick. It's a place that you can look and say, when I bounce, when I come back up, now can I get over it or not? 2099. And look at that. It's almost a round number 2, which everybody loves. So as it comes back up, 2099 is going to be a key spot to measure against. Because now think about another thing, and this is not classical, although I have my own spin on it. This is an ABCD structure forming if we bounce tomorrow. The way you measure an ABCD structure, and it's too bad I can't put lines on the chart here for you, but you take the top, well, you look for some area where price has peaked if we're doing an ABCD structure to the downside. If you're doing it to the upside, you look at some area where prices have fallen as far as they're going to go, right? They've depressed to the point where that's the low. So, and a lot of times it ends up being a swing point high and swing point low, not always, but most of the time. So that high, you come all the way down to today's low, and if we bounce, and if tomorrow, if the low of tomorrow is higher than today's low, and the high of tomorrow is higher than today's high, then that becomes a C point. A B point. So that's your A up here at the top. Your B is going to be down here. And if those conditions I just talked about, higher high, higher low, happens, that becomes the B. And then the C is going to be wherever it goes bouncing to. And I've just said that, you would think this is going to be the key test on the swing point high, about 2099. If it bounces up to 2099 or in that area general zone and then starts to fall, and now you get a lower low, lower high, Now you've got the C point, and you can get the ABCD structure, which is the difference of this high to that low, that high, the next low, which should be the same distance, 1 to 1. Now the thing I do different than most people is I do two things. One is I look at this as a percentage instead of an absolute arithmetic number. So usually, and if you know, if the charts are like these are, they're going to be very close. Some of them are not, like small stocks, very cheap stocks, or a lot of times percentages can be very different. And then the other thing is, I look at the weighting when you break it, to tell me whether or not it's probably going to continue or not. So if it makes a bounce up to here, and let's just find one that's in here, like right here, this high, April 27th, pushes to this low on April 29th, bounces, right? So a higher low, higher high, bounces to May 2nd, and then continues on. If I take the difference between this number, and there's an easier way to do the calculation, I'll do them both ways. 2099, let's just call it 2100. The low is 2052, so that's 48 points. Take 48 points from the high of the C point, 2083, so 48 points from that is 35. So this should try to get down to 35, got to 39. So almost completed, didn't quite. The other way to measure it, it's easier, is you just take this high, I was here. You take this high, which is 2100, and you take this high, which is 2066, that's roughly 34 points, and you take 30, actually I don't know if it's easier, but I do it this way a lot. Take 34 from that, and that gives you that number, or at least the target. So it's, the difference between the high and the low should be about the same. Those are ABCD structures. So if we get the bounce here, this is going to be the key significant bar on the way back up, and that's our test point. When we get up there, if we can't get over it, you have to start thinking it's going to try to come down again. Again, using the test that the market gives you, the information it releases, gives you an indication of what potentially can happen next. And depending on everything that's happening, right, you can put trading plans together to take advantage of those potentials. So if I bought here today, which I actually did buy some stuff, like CMG, as this market moves back up, I'm going to want to probably pay close attention when it gets up into this zone around 2100. If it gets that far, and if it starts to fail there, and let's just say CMG rises with it, that would probably be a point to think about taking some profits on that trade. Because the general market, as I said before, the general market, you've heard that rising tide lifts all boats. Well, a tide that's going out sinks them all too. So if this thing is weakening, that's going to put pressure on the sectors. Sectors going to put pressure on the stocks. If it's strengthening, going to help the sectors, going to help the stocks. And it's not everybody, but it's most of them. And so that's how you can use general markets to help you in your trading endeavors. Okay, let's move to the next topic. We were talking about anchor bars, so let's continue. So we've talked about wide price spread, we've talked about high volume, and the swing points are fairly obvious. And those, as we talked about, they get calculated based on 6 bars. So let's just do that real quick one more time. Here's a swing point high. Count 6 bars to the right. If you find 6 bars without a higher high, that potential swing point high becomes actualized. So let's do it together, and we'll do 2 sets so you see them. 1, 2, 3, 4, 5, 6. Once this bar prints, that one gets an H, swing point high. Now this bar, because it's the one that printed and that one became actualized, it becomes the potential swing point high for the very next count. But this one's higher, so we don't use it, we use this one. Well, this one's higher, now that one. Now we get 1 bar, oops, higher. And until we get up to here, and then start down, right, we go 6 bars, that one becomes a high. Same thing on the low side, does the exact same way. So that's how you count your bars, that's how you get your swing point highs and lows. Your breaks is when you break over them. Whether it's suspect or confirmed has to do with the volume on the break. Green means it's confirmed, has a higher probability. Red means suspect, doesn't mean it will not continue, just means it's a little less probability continuing as long. Feeds into that MTTF number, right? The MTTF on a suspect trend is going to be a different calculation than the MTTF on a confirmed trend. They're different calculations. And when it transitions, like in this case, doesn't transition but reaffirms, and it reaffirms weaker, it changes which MTTF you're looking at. It switches to a weaker one in terms of continuance. Okay, so that's anchor bars. Which ones are significant? Well, anchor bars are your significant points, and so when you're looking at them, those are the ones that you want to be concerned with. And oh, the last thing I forgot to tell you, it's in the notes there, is when I'm doing volume calculations, I told you I just find the top 6. Those 6, I do not keep them. You can have a max of 6, but you won't always get 6. Why is that? Because if the volume of this bar is not greater than 150% of the average of the bars, then it's not going to be counted as a high volume bar. So in other words, I want it to be, something that sticks out like a sore thumb kind of thing, right? I don't want the average to be up there with it, and it just happens to be a little bit more. It needs to be 1.5% as much. The same thing on the white price spread. They need to be the same sort of thing. Zones. Now, how do you construct the zones? Once we have anchor bars, the algorithm that runs, it goes and it looks at every possible combination of putting those anchor bars together in one of 2 ways. One way is they overlap. So let's take an obvious case here. See this swing point high and this swing point high? It takes the low and the high and the low and the high of these bars, and it says, is there any overlap between them? And in this case it was. There was a high here of 2099 and a low here of 2096. That says that can be a zone. Now, as you notice, it didn't get red because it didn't have as high a value as the one that showed up here. And so the calculation goes through, you can get a max 3 zones, and it has to be the highest of the 3. And if you can't find any that have enough value, in other words, they're all 0 in value, and it goes from 0 to 1, the way the point system works. And this is the only thing that's proprietary in my system. I don't really publish this anywhere, but essentially it goes through and it looks, does all the calculations, and depending on some internal calculations I have, it decides whether or not there's enough value to make it a resistance zone or not, and a support zone or not. And then those that have the highest values are the ones that get on the charts. But essentially it's a ranking system, and one way it can rank is it has an overlap. The other way it can rank is where it doesn't. And so if we take one of those, let's call this one a wide price spread bar, because it looks like it is. That's the May 24th bar. And let's take the next anchor bar up here on the left, on the right, which is a low. It's 2085. 2085 minus 2079. That's about 6 points. Now, I may have it in the notes here, but I forget exactly what the number is. I don't have it in the notes. But the way that's called a congruent zone. In other words, they don't overlap, but they're close enough together that we can use them. That closeness, I forget the exact number, and I don't want to tell you wrong, but it's fairly small, and it's based on a percentage. So if it's like, let's just call it 1%. I don't even think it's that much actually. But if it's, if it's within, say, 1%, then it's a candidate for a zone. If it's not, it throws it away and it looks for the next one. And it goes and finds all of them, both above and below current price, and then it assigns those that have the highest point system as the zones, both in support and demand. Now, what do you use them for? Usually The zones are going to give you areas of significance. That was the whole point, right? Just like you would see zones on anybody's technical charts, that's what these are now. The thing that's different here is there are no, vertical, angled zones. They're all horizontal because they're all based on price volume, all of them, right? And so you can't get anything but that. So when you look at like fan lines or trend lines or all those things, I don't pay any attention to that stuff anymore. I mean, I know they're there and I know people are doing it, but to me it doesn't mean anything. If I draw a line from this low up to that low, it may just happen that there may be one that lines up like this one, June 3rd. And so now all of a sudden people think that's significant. Well, maybe it is, but maybe it isn't. If I draw it, it depends on where you draw it. What about this one? What if I drew from this low to that low? This one perks underneath it. Should I have sold it there? You know what I mean? I just never found that to be that valuable. And when I finally developed this system, I realized it was totally invaluable. And yeah, so it'll work sometimes, but yeah, that's like happenstance. I don't think it means anything because what are you after? You're after supply and demand. You want to know where people are willing to put their price, their money, or not. And they're not going to put their money, if they're willing to, think about it this way too. When you get up into the swing point high, let's take this example here, and you break it right there. Are people willing to put more and more of their own money on the line at higher and higher highs or not? The volume will tell you whether they are. If the volume tells off, they're unwilling to. And if the price tells off, they're unwilling to. Or, well, if the volume tells off, they're less willing to. If the price tells off, they're unwilling to. That's where the test failures take place usually. And so when you're looking at a chart, think about it in terms of supply and demand. Think about it in terms of would I put more money on this, or will people put more money on this or not? And conversely, in other words, will I buy more and add to what I already have or get new ones? And conversely, on the bottom side, are people willing to keep putting more and more of their stock out for sale at lower and lower prices? Are they willing to just throw it away? If they're not, you're going to see reversals just like you see on this bar compared to the test that it did on these two bars. They test, they get under, and then they give it up, right? Sellers walk away. The price bounces right back up. Those are test failures, and those are telling you supply and demand equation changed at that moment. Most likely. And if it turns and just keeps going, then in fact, it was an aberration that day. Now, sometimes the market doesn't always give you good clues. Most of the time it's pretty good, but sometimes, I don't know how the market does it, but most of the time it gives you pretty good clues. Sometimes it doesn't. And those sometimes you just have to mark it up as like, okay, that's an aberration. There's nothing I can do about it. That, it's the black swan kind of thing, right? Even though we're not talking a major event here, it's the thing that's outside the norm and the expected. So, okay. So let's see here. What do we got? 413. Okay, I'm doing all right. Let's. We're actually churning through this pretty good. I know it's a lot of material, and your head's probably spinning by now, but we're making good progress. So that's the zone. So there's overlapping, and then there's congruent. Let me go back up and start back in from where I was. Bear with me, I'm going back to the top of the document. So we talked about breakouts, retraces, trend. We just tackled ankle bars, and that led me into the zones. I talked about that they're horizontal, and I'm on page 7 now at the bottom. Support and resistance zones. A lot of times you'll hear me talk about them as anchored. And the reason that anchored was just trying to say that this thing's not moving. It's this is a place where you should expect buyers to try and come in or sellers to try and come in. Oh, and the other thing I made a note here is like I don't always know think about it this way. If you read like Market Watch or any of the rags that are out there, you'll see stuff where they talk about, oh well, oil was doing this, therefore the market went down, or blah blah blah. That's why this happened. That's nonsense. I mean, maybe it is, maybe it isn't. Who knows? There's so many factors. I mean, if you're looking at fundamental things, there's just a myriad of things that could be moving the market. Now, some things are really important, but most of them, it's a coin flip. I don't know if oil is what really caused the market to dive. I mean, maybe, some days I hear them say that, and I saw that oil actually trailed the market. It was doing better, and the market dragged it down. So I don't really care, though. It's not about what moved it. It's about how it moved and what it did, what it tested or what it didn't test. Right? That's what's important. That's where the essence is, right? And if you don't pay attention to that, right? If you don't pay attention to that nonsense about what moved it and just focus on what's happening, you'll be a lot better off. When I trade, I don't. Matter of fact, I don't even watch TV. I don't even have a TV anymore. I don't watch anything. I never watch CNBC. I never watch any of that stuff. CNBC's not even there. Is that CNBC the news? That's the news network. What the hell is the one with the market? Like Kramer and those guys. I don't even know what I don't even know what the symbol is anymore. I don't watch it. Matter of fact, I usually have the lights out when I trade. I don't want any distraction. I just want to focus on price. I want to count my bars. I want to find my swing points. I want to find my zones. I want to see the retest regenerate happen, and I want to act on it. Right, and that's what we're going to try to do next that following Thursday when we do that. I'm going to show you how to trade those setups on a very short time frame. Put these principles into effect. And you'll be surprised at how well it works, even on a 5-minute time frame. It's pretty amazing. And if you've ever watched me in the TNT room do that, I think most people are always kind of surprised that I can call the next move. Today I said we were probably going to try to bounce. We didn't get a full bounce, but we almost got back to even. As I told you, the gold chart actually traded it 3 times on bounces today, trading from the long side. Sold out early this morning, bought again, flipped it almost perfectly, and then bought it again and flipped it one more time. And that's all based on these principles, just doing them on charts live, and that's what we'll do to show you to kind of ingrain this in you when we get to it. Let me take a quick break here and ask if there's any questions. If you have any, you can pop your hand up in the room there on the chat and ask, unmute your mic and ask if you want, and I'll try to take it and answer it. And if you're all good, I'll just assume no response is fine, and I'll keep going. And I'll take a drink right quick. Okay. All right. So that's zones. And let's see what else I say about them. Horizontal lines, and they're zones, not lines. I talked about the ranking system. Oh, the other thing I didn't mention is that, if you have a bunch of anchors that are part of a zone, so if I'm looking at this chart and I'm looking at this resistance zone that's in red, I've kind of got this swing point high that's partly of it. And I'm looking to see, is there anything else? Like I've got this high volume bar. If this red came over farther, it would be almost into this. I've got this wide price spread, a high volume bar over here. That one doesn't figure in, though, very well. So that one I don't see all that much. I'm just trying to see if there's multiples somewhere. I'm glancing at this. Nothing on the bottom one. Yeah, this chart doesn't typically have them, but if you can find where there's, when we're talking about significant bars, and you see 3 or 4 different significant bars lining up together at some zone, then of course it has more value, right? More indicators the better in terms of when you're looking at these things. And as I said, the proprietary ranking just really gives a ranking system to it, because you have to rank them, otherwise you'd have hundreds of zones of which is no value. So you rank them, you try to decide what's best, and then you use that as and this is really, when I trade, I don't even hardly look at these zones. I'm really focused on the bars myself. The reason I created the zones was for people that aren't as well versed. When you get well versed, you'll probably not look at the zone. I mean, you'll see them and it'll help, but it's not what I focus on when I trade, because I'm really interested in bars more than zones. And sometimes at least I feel like I can get better reads myself. Going back up here, just go down. Let me see, I got price projections, reversals, magnets, and I'm trying to see where I want to go next. So I'm going to just kind of skip through this and tell you what page I'm on. I'm on page 4. I'm looking at time. So I want to review some of these things I talked about earlier. 60 bars, why did I do that? So I'm on page 4. It keeps the chart from being too cluttered, right? Again, too much information is not good. It also allows you to do the same principles. So like the high number of the volumes per chart, so in other words, I can use the exact same algorithms no matter what the time frame. It doesn't matter. And so you can extend this to any time frame you want to, and it will work the same way. And yeah, I talked about the fact that the swing points can be off the chart, and that's fine. And if that happens, like if we take and look at this chart, and we want to find, if we're just starting at the very first bar, we're not going to mark that one. Actually, we're not going to mark this one as a swing point high, even if, well, let me say it a different way. What I was trying to say is that sometimes you'll end up in a case where you can't quite tell, and it's easier to say if you're like, what's the trend? If this was a little bit flatter here, you wouldn't really know what the trend was if I didn't tell you, and if you were trying to figure it out yourself. In that case, just pull your chart back a little bit and find your trend so that you know on the 60 bars which way it's going. Now, if you're using my charts, you'll know it. If you're using some other charts, you'll have to figure it out yourself. And if you need to, you can just pull the chart back. Because my chart keeps track of it all for you, you don't have to do that. It does it for you. In other words, when you come in here, it already knows what the trend is. And if you don't know what it is on this chart, when you first come in here, just find the very first one and you can see what it was, or what it is now. Okay, so anyway, pull the chart back if you need to is the whole point. Always 3 time frames. So here's an example, day trading, and this is what you'll see me do. I usually have 30, 15, and 5-minute time frames on the day trade. Why is that? Because it's 60 bars almost. If you put them on 5-minute time frames, you can get 60 bars and you watch 60 bars. You do the same thing on 15, you do it on 30. Now you get your 3 time frames for day trading. And you can do this with anything. If you want longer ones, you can do longer ones. If you're swing trading, usually you're going to use the charts like I have, daily, weekly, monthly. The long-term time frames have greatest trend significance. I already mentioned that. And the this is something I didn't mention. So let's say that the S&P 500 I want to trade, and actually let's pick another stock. I'm going to pick a different stock here, EFX. So Equifax. Equifax, of course, sells data about your credit, and they do really well when the economy is doing well. Well, Equifax has been on a long-term trend up. I'm going to go back to a monthly chart. This thing has been going up forever, right? From 28 to 118. Okay, so that's a long-term trend. So like, where do you buy it? Well, you can't really use the monthly to buy it. It's not very useful. I mean, you can have it part of your consideration, but it's pretty hard to use this chart. If you drop it back to a weekly, right, you can get a little bit more timing into what you're going to do. And so on a weekly chart, I could look at, for example, this breakout, and I could buy that retest reach in right there, right? The high here, using our principles again, was 114.46. The low, 113. So it tested after the breakout. It tested back into the swing point high's high. Does it 2 bars, takes off, right? Now if you're scaling in, you could create a money management, trading plan that says, okay, I'm going to buy some because it's been such a strong stock. I don't know how deep it's going to come. I'm going to buy maybe a third of what I want up there, or 20% of what I want. And if it comes back deeper, I'm going to buy, because this retest region zone goes from 111.35 up to 114.46. Maybe I'm going to buy at 114.11, 113, or 112.60. I don't know, somewhere in there. And then I'm going to buy again at the bottom. Now let's take this and move it to the daily. So hopefully this is within 3 months. Actually, it's not. So we're not going to be able to see it on the daily now. I do have some programs now that let you slide back in time, but they're not quite perfected. So it would be nice you can slide back and see this. What did the daily look like back here? My guess is, actually we may be able to see. So let's go to the daily. So that time frame is, the price point is 114.46 to 111.35. Let's go back to that 14.36 to 11.35. I think this is the bar right here. Let me go back to weekly and get the bar right quick. What date was it? Is this breakout bar? March 28th. Let's go back to the daily. When you have them all up together, it's easier. I'm switching just to make this Skype session work. March 28th. Okay, so the breakout took place on this week right here. And then here's all the little bars that took place that we saw in 2 weeks. They took place here. So here's 1 week and here's the low of the next week. Those are those 2 weekly tests that we saw. Now if you look at it here, this is a swing point high. There was probably, actually right here you can see the breakout. This is the breakout bar, so the high was over here somewhere. So these are testing into it. So you could put, depending on how wide that daily bar was, you can refine what those weekly entry point numbers look like. So you can narrow it down. You can put your trading plan based on lower and lower time frames, right, to get your timing better. And matter of fact, a lot of times when I'm entering, I will, because I trade, rather rapidly, I'll take it all the way down to like a 30-minute chart or 15-minute chart to time my entries. So if I really wanted in this chart, I probably would have taken this and looked back into the dailies and saw if there's anything significant there that I could key on to get my first entry. And so I'd kind of look at all of them and then use those for the exact timing that I want to do to try to get into something. And again, you're always buying one of two things. I'm a retrace trader. People tend to be breakout traders or retrace traders, and we actually haven't talked about that. Let's talk about that real quick. Retraces. And matter of fact, the data is in your notes. Let's scroll down to page the visuals start on page 28. So if you go down to 28, look at the very first chart. Number of bars prior to the first retest region. I'm going to switch the screen here. Well, you all have your documents up or no? If you don't, tell me and I'll switch. Oh, okay. Well, I'm sorry. I'll have to send it to you. Shoot me an email and make sure I send it to you. Let me pop this. Okay, I just haven't seen it yet. My apologies. Let me pop over and share this chart then right quick. So where is my share? Pop over. And you should be able to see the chart now. This is in the book, one of the books. I think it's in the third book, where I did a lot of data crunching. I did a lot of data crunching actually to write the model book, to the second book, but I actually presented a lot of data in the third book. Look at these bars. This says anytime you break out, depending on the type of trend it is, and these are the types: confirmed bullish, suspect bullish, confirmed bearish, suspect bearish, right? Those breakouts. Anytime you break out, the probability of you retracing is anywhere from about 68 to 82%. So any breakout that takes place has a probability in the area of 68 to 82%. So what does that say? It says most of the time it's going to come back. So you can either be a breakout trader or a retrace trader, and there are some breakout trades that I take, but most of the time I buy retraces. I just tell myself, hey, I know most of the time this thing's going to come back, and so there's no reason for me to go chase it. And so I will look for the retrace and buy the retrace. Now the one case I don't do that, and it's really the only case I don't do that, at the time that I buy breakouts, is when I see breakouts occur on multiple time frames. And I know you've seen me write about that, and that is, or talk about it if not write about it, and that is that if I see us breaking out on a daily and a weekly and even a monthly, and it sticks right on the weekly on the highest time frame, there's another chart that you can look up that talks about what's the probability that that is going to continue without coming back, and it's pretty high. If you're in a bearish trend, it's about 92% if you break out on multiple time frames. If you're in a bullish trend, it's a little bit less, but it's still very high. That's the time I'll buy the breakout. So I'll just throw caution to the wind and jump in. The bad thing, of course, on a breakout buy is your risk is a little bit higher usually, because you really have to allow, or you should, to keep from getting chopped up, you have to allow for a retest regen to take place, which is the bottom of the bar that you broke. And sometimes that can be a big bar, especially on the longer term time frames. If you're buying the retrace, of course, it's closer to where your stop out is going to be, right, as it retraces. As a matter of fact, if I were buying, let's talk about this retrace right here, the breakout is here. If I buy this retrace, ideally from a money management perspective, so here's the swing point high, top is 116.80. You get over it, and you come back into it, and you dig as low as 115 roughly, and the low is 113.5 roughly. Okay, I would want to buy in stages on the way back, and I would want to buy in larger and larger percentages on those stages as long as it came back properly. Now what does that mean? That means that as I come back, I see less and less selling interest. That's one thing I'm looking about. And if I come back into something that I can measure, and in this case it's not great, but there's a little bit of a kind of a wedge that's formed here, right? A little line in the sand, if you will, across these highs. If it comes back into that and has trouble, right, that would be a place to add another one. I would have picked these out ahead of time already. And then the last one, of course, would be this low. This low has, or this swing point highs low, has about 726,000 shares on it. If I were to come all the way back into that, and let's say I only did, I don't know, 200 or 20,000, and I get under it and back over it, and then I'd want to buy my last piece and then put my stop underneath it. Now, the stop itself is always important, and there's some notes about it, but I'll quickly give you that too. If I go back to the ATR, or I go back to the trading cube, and you can find this elsewhere, but I actually put it here too to aid you, and we take Equifax and put Equifax in, and go down to the very bottom down here. There's an average true range. This is Wilder's ATR, except for I'm using a 10-day number instead of 14, I believe is what he used. I want it to be more recent. This is telling me on a daily time frame I can expect a $1.44 move on average each day. What I do is I take, depending on how conservative I want to be, I take 20% of that number or 25% of that number. The more conservative, of course, the bigger the percentage. So let's just take the 20% of that is, what is that, about 20, almost 30 cents. So 30 cents, and let's go back to our chart now. Equifax. Oops. And if I were trying to buy Equifax on this retrace, we were here, right? We were retracing there. Where would my stop be? Well, I want the bottom of this bar, 113.57, minus that cushion that I just talked about, the 20 something cents. So I give it that cushion and say, okay, I'll give it, you know, well, actually what I do is I calculate it. So this is, that would be about 24, I think I said. So that'd be 113.33. And then I say, okay, 113.33, where's this low? 113.09, okay. So that's what I kind of do, and I say, okay, well, do I give it to let's say 113 even, or 113.01 or something? And I might do that because there's a swing point low there, or I might not, you know, depending if there's nothing there. But I want to give it some sort of a cushion because it's not going to trade exact, right? It's not going to come to that number and turn. But you can be sure that if this market is still wanting to go up, when you come back to something of significance like a retest regen, you should expect them to try and buy it. If they don't, then that move it's an early warning system that move is probably over for now, just like what you see. Actually, this one hasn't quite done it. Equifax hasn't. Here's a swing point high. The low is 122.14 now. Today you got to, well, look at that. That's what I was just talking about. So today's low, this is a retest regen. You break over a high here, you come back in to test it. 122.14 is the low. Today you get to 121.83, so you get under it, back over it. But what do? You have more volume. Now, there's two volumes you want to look at when you're doing a retest regen. You want to look the highest volume of the bar that was broken or the bar that broke it, whichever one's highest. In this case, this is the highest one. I did 831. I'm hitting it today with 1.1012. Hitting it with more volume. What does that mean? That means that it can do it again and try to break it down. Now, what else is on this chart? There's another thing. That's this big guy over here. His high is 122.55. So this is testing not only a retest regen, it's also doing a test into the high of the big wide price spread high volume bar. That bar is significant. If it gets into that bar and stays into it, then it's going to try to get all the way down to the bottom of it. How far does it have to get for it to try to get to the bottom? I usually take about a third. If it gets about a third of the way into it and stays, then I'm guessing it's going to get to the bottom, right? I mean, the odds favor it to get to the bottom, or at least get close to it, right? It's like a magnet. As a matter of fact, that was one of the next things we were going to talk about. It just kind of magnetizes down to it. And it's the same thing on the way up. It magnetizes up to it. And so this test that's taking place on this particular chart right now, it's negative on the test of the retest regen, but it's positive on the test of the swing point high because it's not nearly as much high as it tests into it. Now the top was 122.55 and it closed at 122.37. That's a negative. You'd like to see it come into it and bounce right back out of it. In other words, the buyers see that as an opportunity. Again, supply and demand. They see it as an opportunity to jump all over it. If they do, that's what they do. They jump all over it. If they don't, back the other way, right? It just continues on down. And anyway, that's I just gave you my analysis of Equifax. Actually, I own this. I didn't add to it today because volume was too heavy, or it looked like it was going to be too heavy. So I just didn't. It's not clear. There's not a clear signal here to buy it, and you got general market kind of acting up. So there's no reason to buy it yet. You want to let it test a little bit more and give you more information, and then make a decision if you want to buy some more. Okay. All right. So let's see what else. Let me go back up to where I was in the document. So price and volume. Okay, so I'm at the bottom of page 4, price and volume. The price typically has low meaning without volume, also doesn't mean much until some sort of a test. Really, it's all about test. And so when you get a test, you get some information. When you get some information, you can make some decisions, or at least you have a better idea of what might be happening. Tests essentially are the same, right? All tests are the same. They're doing a comparison. They compare something. And that comparison is what you want to do. And if you learn how to read the comparison, just like I was reading on this Equifax chart, right? I'm reading what's the comparison here on the big wide price spread high volume bar. What's the comparison on the retest regenerate? You know what I mean? You're looking at those comparisons and you're making decisions based on what those things are doing and how those tests play out. And when you do that, you'll find that you're not like if I were to buy this today, I may be just setting myself up for a run all the way back to 115, right, to the bottom of this guy. You don't want to do that. Now, if I bought this, I may have a stop up higher, or I may be an intermediate term trend that I'm trading in a long-term trend, and I may be willing to let it come way back here, and that's my next buy. That depends on your trading plan. You always have to decide when you're going into a trade what the time frame of that trade is. Now, it can be multiple time frames, and there's nothing wrong with that. I do it all the time. But you have to stick to whatever those trade parameters were when you started. So if I go into this and I'm thinking daily trade, a little swing trade based on the daily time frame, then I have to stick to that time frame. Don't go changing your time frames in the middle of a trade. You're just asking for bigger drawdowns. You're asking for trouble. If your plan is intermediate, that's one thing. If it's not, don't go changing it because it did something you didn't like. Or would it stopped you out and you didn't want to pull the trigger. Don't change your time frames. Don't change your trades. Okay? And actually, if you're doing a day trade, or if you're trading on a daily time frame here, this is the bar, right? This bar got over that. If I were to draw a zone and look at the time frames, see the volume here as it got over, even though it's suspect it's decent volume compared to everything else, I don't want to see it get under this bar if I'm trading on a daily time frame. 121 to 24. If it did, I'd take the ATR, which is about 34 cents if I remember right. That'd be about 120.90. I'd put my stop about 120.90. If it knocks me out, I'm out. And I'd look at it lower. Or I'd look at it later, depending on what it does. Okay. Okay, so we're kind of getting towards the end here. Let me review how far I've gotten. Maybe in order, while I'm reviewing, y'all could unmute your mics and maybe just tell me your first impression and what you'd like me to do different to help me for Saturday. And I'll review where I'm at the same time. Maybe in just alphabetical order of names. Can you all see each other's names there? I can't say left to right. So it looks like Anna Marie's first if she wants to go first. And this is for entry, not existing position, right? Gotcha. Yeah, and that answer to that, let's just take them. As a matter of fact, let's just answer some questions. These are great. So, like, I'm going to use the Equifax here. Here's your breakout. And you want to buy the retrace. I think that's what you're asking me. How far do I allow it? You allow it back to wherever the bar of significance is, and in this case it's the retest regenerate, and then this bar next to it, which happens to be the breakout bar of the prior swing point high. Now it will change depending on the chart. That's this chart. Most of the time it's always going to be your retest regen zone. Why is that? Because if the retest regenerate zone fails, that says that the trend that was up, more than likely for now on this time frame, has changed to sideways. You don't want to buy it, if it's no longer going up, right? You always want to buy something that you think is going to continue up. And so what you want to see it do is come back, test, and the demand comes back in where you expect it and doesn't get in below it and stay below it. And right now, this one, for example, isn't telling you that. It did hold today, but it held in more volume. You want to see it tested again now. If it came in tomorrow, no volume, and reversed, in this particular case, this would be a place you could buy. If you're doing a daily time frame trade, you could buy it, stick your stop. I put it right underneath this with the 34 cents, which is 120.90, and take that risk and try to buy it somewhere around 120. I don't know, 122 somewhere, 122.50, wherever it is. I'm shooting, and we haven't talked about that yet, but this is where there's two things you want. One is the question you just asked, which is where do I try to buy it, to get my probabilities on my side, and two, what's my reward to risk? In other words, how far do I expect this to go on the entry? And I always do worst case. And so if I expect this to go back up, worst case is it gets up to here and fails, 124.65. That's going to be the key price point on the way back up. So what I would do is I would look at it from a perspective of, let's say I buy it at 122, my risk is 120.09 or 120.90, so that's what, $1.10. And my reward, if I get it at 122, worst case is about 124.50 or so. So I've got about a 2-to-1. That works. And I really think this thing is bullish, so I just want to get a leg hold somewhere, right? And I'm just going to let it come up there. I'm going to let it test. If it fails in that area, I probably take part of my profits or all of them and then try it again or try it with some other stock. But if the retest regen is your answer, usually in most cases, sometimes you have a mitigating factor like this big bar that's also helping it out. Okay, next one, Bob. Okay. Okay, let me just summarize the retest regenerate so that because you can see the screen now. Anytime you break over a swing point high, that high and low of the swing point becomes the retest regenerate zone. And what it means is anytime prices retrace to that zone, as we see here with Equifax, anytime it regenerates to that zone, buyers, if they continue to think the future's good and the demand is there, they should come in and buy it again. That's how they do it. For whatever reason, that's what they do. And the reason really is, if you think about it, it's the lowest risk entry point on that time frame, right? Whether you're looking at the weekly, the daily, they're always going to be the lowest risk entry point on that time frame. And so as it comes back in, it's going to try and quote unquote regenerate back higher because that's the direction it's going. So as it goes up, it comes back, it tests, can't break down, in other words, can't get under the low and stay under it, the low of the high, which is the bar that was broken here. That is the retest regenerate, and that's how it works. But yeah, sure, that's fine. I'll let you look it over and then maybe ask a question on the next one. As you finish to mute your mics if you haven't. Richard, I'll let you go. If you're talking to me, your mic's off. You have to pop your mic up. Okay, I'll scoot over to Patrick next. Hey. Yeah, I'm a fire hose, man. You know, for me, it's secondhand because I've done it for so long. Of course, I created it. And so, you know, for me, it's nothing. But I have seen it, and realize here, I know I'm feeding you a lot of stuff, but I want to give you enough to let you have a good sense of what I'm doing. And if you don't get that out of this, then I probably failed. I know you're not going to catch everything, but if you get a good feel of the concepts and you see me doing it, then you can start to get more out of the videos you see me do, right? And the words you see me say. And you'll be able to follow along. And it's just like I remember when I first took my economics class, the first one I took, Economics 101, way back, God knows how long ago. The teacher, he says, your first assignment and your assignment all year long is to go read the Wall Street Journal. And I thought, wow, that's kind of an interesting assignment because I'd never even picked up the Wall Street Journal. And I went over there and read it, and I didn't know what the hell they were talking about. You know, and it was that way for like a month. And then, you know, pretty soon I started picking up on stuff. And that's the way this is. You just have to, you know, look at it every day. And pretty soon you'll start picking it up. Max, anything from you? The blue ones are anchor bars. And anchor bars can be one of three things. They can either be a swing point, like a swing point high that I'm highlighting now, or it can be a wide price spread bar, which this bar is also, or it can be a high volume bar, which this bar is also. Any of those, if they meet that criteria of 1.5% greater than the average of the rest, they get a blue. And so if you look at this chart, you can see this one's blue, for example, on May 10th. The one next to it is blue. Those all had enough volume, or they were wide enough, probably wide enough price spread compared to all the other ones to get a blue designation. So blue just tells you it's an anchor bar. No, 100. So if I'm doing a wide price spread, I want to take all the price spreads of all the bars I'm looking at, 60 of them. I want to take the average range of those bars. So in other words, let's say this was 30 cents, this was 20 cents, this was 20 cents. My average now would be like 23 and a half. You follow me? And once I get that number across all 60 bars, now I compare every bar to that number and say, are you, well, first I rank them, right, and take the top six. And then I say, is the lowest one of those six, the top six, is it greater than that 1.5 of the average? If it is, it's an anchor bar. If it isn't, I go to the next one. And then I give them all six an anchor bar if they are. What was the other question? Yeah, what about it? Yeah. Okay, so let's talk about two things. One is the breakout itself just tells you the probability of continuance of the trend. It really isn't. Sometimes it can be a significant bar in other ways, but it really is just, it's giving you trend transition or trend reaffirmation. So it's either confirming an existing trend, either as weaker or stronger, or it's telling you the trend changed. The retrace is focused on primarily on the top and bottom of the bar that was broken on the breakout. And so in this case, that top and bottom of Micron is the April 28th bars, 1241 down to 1152. So the fact that it came back in and tested it, looks like 2 bars after it broke, actually 1 bar after it broke out, says that it's probably going to continue, that it's going to try to get to the bottom of the bar. The So the bottom, because it's within 6 bars. So the bottom of the bar is 1152. So what you're looking for is for it to get as close as possible to 1152. And actually, you know, as I'm looking at this chart, and again, I'm just going to spill more information on you guys. I'll try to keep it short though. Look at this bar here. Wide price spread, high volume. And its top is 1165, which is very close to the bottom, which is 1152. So the 1152 to 1165, actually, if my charts were a little smarter, they would have drawn that as a green zone. That would have been a nice zone, actually. And it may, yeah, I don't know. Let's see what the weekly looks like. Oh, okay, so this has been in a downtrend. Yeah, now this is interesting. So when you look at this chart, it broke out here, and it could trade all the way back. You know, if the daily doesn't hold, right, the weekly takes over, and it could trade all the way back to 1059. And so if you're taking a long entry, you really want to be tight stops on it, because this could trade a lot lower unless you're really trying for a big turn, right? So if I were trading this and I was trying to trade it long, and I was using that retrace on the daily, I would try to get as close as possible to about 1155, 1160, and I would have a stop very tight, 1140 or something, whatever the ATR 20% of it is, underneath that swing point low. I wouldn't give it hardly any room. And the reason for that is because this thing could drop another 10% before you know it. You can. It depends on your time frame and what you're trying to do. Matter of fact, it's safer to do exactly that. What's the risk? Never does it. Just goes higher. Right? That's always your, you know, there's two types of fear, right? There's the fear of missing out, and there's the fear of, you know, getting hammered, right? And in this case, a lot of people will trade that daily, trying to make sure they don't miss out. If you ask me, I wouldn't trade this until it got down to there. I was just trying to answer your question on the daily. Yeah, matter of fact, guys, one of the things that you're going to learn, guys and gals, sorry, Anna Marie, is that you want to find your best trade, right? And so big money can be made on trades like this that are really turning. The problem is, and let me put this on a monthly just out of curiosity to see how negative it has been. Oh, that's kind of interesting. Look at this, guys. It's coming back to the retest regen on the swing point high off the breakout from way back here on a monthly, 2012. So it's come all the way back to do the retest regen. Hit it with more volume. Let's get the numbers here. 931. 935, and this top was 916. So it hasn't quite got to it, but I mean, it's close enough when you're talking about monthly numbers, right? To get bounces off of that. So it's trying to put in the bottom here. Now, will it be a bottom? Will it actually test into it? My guess is it will test into it, because it typically does. And so, yeah, when I look at the monthly, I even want to be more careful. I want to wait for that test. Just like the CMG I was talking about earlier, you want to wait. You want to wait. You got to be patient, and it's hard to be patient. You know, I mean, CMG, I waited like, I don't know, it's been 2 months now. Just put it on my list and just, you know, monitor it. And I haven't talked about the monitor. I should do that next. But here's CMG on the monthly. This is 1, 2, 3. Yeah, it's 4 months after this low. I've been waiting ever since this low was put in. So it's like 4.5 months now. Let me show you one other thing, and I'll go to the next caller or participant. If you go here, Stock Monitor, I haven't talked about Stock Monitor. One of the things you can do is you can put, if you create stock list, right, your watch list, you can monitor. You know how when you're trading with your broker, you can go in and put your alarms in, and you can say, oh, okay, if it hits 11.24, alarm me, tell me something happened. This thing does it automatically. It doesn't care what the level is, and it just keeps doing it as long as it's on your watch list. And let me tell you what it does. And let me go to I think I actually have this one still sitting in temp if I remember right. Yeah, there it is. That was on what time frame is this? Short-term time frame. And let me go back to my chart here. CMG. Oops. I'm doing this live, so I might look like an idiot. Oh yeah, that's on the short-term time frame. I think it's on the weekly. I saw it last week, and those aren't here anymore. So I got alerted to it on the weekly. Let's see if it's still here. I think it's actually off the board now. Yeah, because this only keeps it 2 days. So on the weekly, on Saturday morning, I believe this thing alerted. I'm pretty sure that's why my attention was on it again. I don't remember, but because I see a bunch of these. But I did put it back on my screen again and actually set a physical alert on it myself with my broker Monday morning or Sunday evening or something. And the reason for it was that on the weekly, it told me, and let me pop this to the weekly for you. It told me that it was retracing. It was a bearish retrace, and you see how close this was to that low. What this signal did over here on the stock monitor on a weekly basis, which is done every Friday night, is it said that there was a bearish retrace to a potential bearish breakout. That's what it was, a potential bearish breakout. And what that says, and if you guys want to look at these things, there's a signal help page. If you hit that, it pops you over and it tells you exactly what the criteria is as to how this triggers. I want to explain something else in a minute, but I don't want to confuse you. So you hit that'll tell you that. But if I go back over here to the stock monitor, the potential bearish breakout, I knew that eventually this thing was going to come back, or I expected eventually it's going to come back and test this low. And I know, because at the time I knew it was high volume, I know it's probably going to fail when it tries to test it. That was my expectation. And the key was just to wait until it did it. Well, it's finally done it. So when it told me on a weekly basis it was a potential bearish breakout, I knew that I was close to the swing point low again, just because of the signal that was issued, and because I had flagged this in my mind a long time ago. So then I went and looked at the charts, specifically to see what it looked like. This only fires when the ATR of the weekly time frame is the price of the stock is within the ATR on the weekly time frame. The percentage is within the percentage of is within the low, close to the low. And so when that happens, right, you have a situation where it's close enough to trigger an alarm to get your eyes on it again. And that was what brought my attention to it. And so the stock monitor does that against two types of trades, right? Always does it against breakouts and retraces, potential bullish and bearish. And so you have 8 combinations. You have bearish and bullish breakouts, bearish and bullish retraces, potential breakouts, potential retraces, both sides. So you have 8 possibilities. Anytime it's within the ATR on the potentials, it alarms. Anytime it actually happens on the breakout or retrace, it shows up here, and it will bring your attention back to an opportunity potentially to do something. So this is a great tool for you when you have stocks that you want to monitor. You get them in a stock list, and then you watch it, and then every day you just pop up your stock monitor to whichever one you're watching, right? And then you can just quickly flip through the charts, show all charts, flip through them all, 3 time frames. That thing I showed you at the very beginning, where you can set your charts up on your screen so you can see them easy, and then you just pop through them all. While I'm here, real quick before I forget, the difference between stock monitor and trading signals. Trading stock monitor works on the exact same principles as trading signals, except if you go back to the help, trading signals looks at all of these these things that should happen or could happen, and it wants 80% of them to happen. That's when it issues an alert. So it's trying to find trades for you that have the potential to do something big, right? So when 80% of the criteria are met, then it creates a trading signal. At the very top of the page here, I think I tell you that for Stock Monitor, I think I stuck it in here, I can't remember, but Stock Monitor doesn't care about 80%. If any of them happen, it tells you, right? So those 8 things, right? If it's close within a retrace, it doesn't care what the volume is. It doesn't care what the rest of the sector is. It doesn't care about all that. It just says, hey, you're close enough within ATR of the retrace, boom, we give you a signal. And so it acts like an alarm system. Okay, so I left off with, I think, was it Max? Is John next? Sure, Scott? The guitar man? Yeah. Oh, cool. Okay, great. Yeah, go ahead. Okay. Okay. Actually, we will do money management on the next session, so I'll throw it in there. Y- Scotty, I actually have a program that does that. And it, again, another one of those, I'm always working on stuff. I've got a program that allows you to trade a live chart from some period back. It doesn't tell you who it was. It doesn't tell you what the time frame was. It does give you all the 3 charts and all that business, right? You know what your sector is and so forth. And it does it bar by bar, and it allows you to use your Neoclassical. It has all the Neoclassical stuff on it. Allows you to make the trades. Yeah, and it's almost done. I've been working on it for about a year, and I've just about got it. It's almost there. It's not quite yet done, but it's very close. And that's one of the key things, because I thought that would be a great tool to learn, and then I also thought that it'd be a great tool to do competitions on. If we wanted to do competitions. So yeah, there is that. And matter of fact, if you do stick around and decide to do the mentoring, the full blown mentoring, I do that in the full blown mentoring with people. Matter of fact, I let them tell me what to do. When we're doing the one-on-ones, because that's what you have to do, right? Because in the end, you're the ones going to make the decisions. Okay. Okay. Do me a favor though. Shoot me an email, or let me actually shoot me an email if you will, and just remind me of that question so I make sure and cover it. The one about the scale and scale out stuff. Okay. That way I won't forget. Yeah. Thank you very much, Chuck. Can I answer some of these real quick as we go, so I don't have to remember them? That one's fairly easy. I always use the ATR, and most of the time I kind of know what the ATR just looking at the chart, so I don't actually go look it up every time, and so I'm kind of ballparking it. But what I'm really interested in is I use the ATR to give me an area, and then I look for things of significance. And so if I see a swing point or a high volume bar or something like that that's in that area, then I can key off that bar. And that's where I end up putting my stop, just like into the bar or something, because if they're going to come in and buy it, that's where they should buy it. And so I use the ATR to give me a range, and then I look for something significant in that area. Certainly, and the difference is you're using the ATR off of that time frame. So in other words, if you're on a monthly chart, let's say you're doing a long-term time frame, you'd probably be using your monthly or at least your weekly. You're going to use the ATR off the weekly, which is going to be a much bigger number. Yeah. And actually, let me back up one question, because I think this is what's confusing too. Let me come back in here to finish this thought. If I were doing like CMG, and I'm putting a stop, in this case it's fairly obvious that my stop is this swing point low and some ATR off of it on this weekly time frame, right? Now, if I were, let me find an example here. Let's say I wasn't as smart as I am, and I know that's hard to believe, and that was supposed to be a chuckle. Um, if I were trying to use maybe this big bar's high as a place to get in, right here, right, these two bars, and it pops down into them, would I be using, again, I'm wanting to buy as it comes back into that. When I talk about the ATR, I'm using, like in this case, I'm using the low and an ATR off of it. If I'm using like this high, I would use the high and an ATR off of it. I'm not talking about my entry ATR. In other words, my entry may be 3 times in my, I might buy it at say $1, $2, $1, 70, 80 cents, and 70 cents, let's say. And let's say my ATR is 6 cents. Well, and my stop should have been 55, so I give it 49. So I'm always ATR off of something of significance, not off my entry point. And I just want to make sure that was clear. Go ahead. Yeah, it makes no difference, and you should keep it probably to no more than 15 or 20. I see a lot of people say you should always, spread it out, but you make the money when you concentrate. So, like, I'll be very honest with you folks. I had 40% of my money in gold over the last month and a half. It's a long-term trade, but I trade around it, and that's the part we'll have to talk about. When I say I trade around it, I maintain, like for example, I got 25% of my portfolio in GLD. I just bought GLL, which is the opposite. I don't want to sell my GLD. I trade the short against it, and then I work my way back out of that short, and I do it at certain percentages depending on how much risk there is in whatever it is I'm, in terms of the time and how far GLD has gone or hasn't gone. Let me bring up the chart here as we talk. It'll be clear. Well, yeah, I understand, and I'm sure that's confusing because I don't have just GLD. I have SLV, or I did. I just sold it. So I should have said precious metals and stocks because I had Newmont and I also had GDX. Yeah, and so I had quite a bit more. At this point, I'm still long. I won't be net short gold because I think gold is making a big turn, or I should say I won't be net short precious metals, which includes the bullion and the silver, right, as well as the stocks themselves, the miners. But yeah, I was very concentrated, and I got concentrated on this last dip more so. And well, I'm sure the stock monitor. Well, I know the stock monitor. Actually, the trading signals started to show a bunch of bullish breakouts back in February in the gold sector. And so I saw a bunch of stocks on the daily time frame, like Newmont especially. Newmont was the first one that I noticed actually because it was the strongest one, still is. And when I saw this guy break out, I'm popping up Newmont, it was back. Yeah, it was right here. It was this breakout. So it came out. If I remember right, it was earnings. It popped over two swing point highs. It was a multiple swing point breakout, and that was the first one that signaled that something was going on in gold, in precious metals. And that was the first one that that was when I really started getting interested. And then I started looking at all the charts and noticing that a large turn potentially might be finally taking place on all these things. And you can see how beaten down they were, right? And so actually, let me go back here a second. That was, let me get my time frames right. I think that was off that was Feb. Yeah, it was right at the beginning of February. Yeah, and then if I go back to the monthly now, um, on the monthly, Feb is this bar, I believe. Oops, let me get it back up. Feb should be, yeah, it's right there. And you see how it was coming over and breaking that high of the low that it had already broken down, right? And so when I saw that on this time frame, and then I was seeing these huge breakouts over here, it was like, okay, something's going on. And so you see something, and then you see a bunch of others, right? Because, like, remember at the beginning of the show, I said, you see one sector, then all of them do it. This is the same thing in sectors, right? You see one stock, then all the stocks do it. It's the same sort of thing. You just rotate between them all. But yeah, I have Nugget and I play Nugget and the what is it, Dust. Yeah, but those can chew you up. I mean, you got to be careful what you're doing, right? Yeah, it's just I'm a fiduciary, so I gotta just say you gotta be careful, right? Because I don't want you guys to jump into something like that. I mean, Dust can move 30% a day. On the daily chart, they're calculated daily. On the weekly, on weekly, they do. And that really, if you think about it, that should happen. Probably shouldn't happen that much, but it should happen because the chart's evolving. Well, it's kind of a two-part answer. One is you're going to want to time the general market as part of your entry. So typically that stock, even if it's counter trend, I mean, even if it breaks out, right? The general market, if it's weak, it's going to kind of pull it back in, or at least arrest it to some degree, which is going to allow you to, instead of trying to chase a breakout, to buy retraces most of the time. And so you're going to be focused on retrace. If the market is generally is weak and you're pursuing any of your longs, you're going to really want to focus on retraces, not breakouts, because the breakouts are probably going to fail more often than not. I try to ignore it. It depends on what you're in. I'm being facetious. If you're in the gold itself, I totally ignored it, because gold right now is moving on. Gold itself. If you And this is where you kind of get into some of the fundamental relationships. Gold typically trades opposite of the dollar, for one thing, and it also trades, to some degree, it also trades opposite of stocks, because a lot of times stocks are a measure of fear, right? And gold tends to be a measure of safety, or at least people pursue it that way. So a lot of times gold will actually trade opposite of the market. You don't always, as a matter of fact, if you just day to day look at the ox markets compared to the ox markets, I'm talking about precious metals, bonds, things like that. They'll trade opposite of what the general market. You don't usually see a green all day, an all everything green day. It doesn't happen that often. Usually you've got, gold's red when the equities are going way up or something. Now, when it divorces and you see, this is where you can get subtle things, where people talk about divergences, and I don't use divergences a lot, but I'm certainly aware of them. I saw, like last week, gold was going up and the dollar was going down, up as well. Well, that just kind of told me, it's like, oh, well, that means that there's a little bit more fear out there for some reason, right? And so you can get little subtle hints that are really kind of, just a collective knowledge kind of thing versus just a neoclassical read. I mean, you got to be able to kind of understand those relationships and then key off of them. And then the other piece of it is, the gold stocks themselves. Yeah, they're reflective of what the general market's doing. So generally, if the market's weak, the gold stocks will have some sort of a drag associated with them. The other thing to realize in this is, again, getting to relationships, is that, and I'm talking about gold in particular, but it applies to other things as well. Gold stocks, if you think of a sine wave, gold stocks have a higher amplitude than gold itself. So you'll see, exactly, and on the upside and the downside. And so if you actually overlay GLD with, say, Newmont, you're going to see Newmont, skyrocket to the top and then drop like a rock to the bottom compared to GLD. And they will go the same generally, but it's just Newmont will outrun it on the way up and outrun it on the way down. And so if you want to the big money and on a big turn, you want to try to get some of those stocks. I'm not sure I caught all that. So you're saying the trading rules. When you say trading rules, are you saying like never buy a breakout? Mm. Monitor, yeah. Yeah, well, the trading signals is the 80%er, the stock monitor is without. Um, yeah, yeah, I got you. Yeah, and in a way, it's captured in this document, though the ranking's not there, right? Um, you know what I mean? I mean, the principles are the model, and so like breakouts and retraces. But I'll have to think about it. I'll have to think about it. You know how I could. I'll chew on it a little bit, see what I can come up with. Okay. Yeah. I'll have to chew on it because I'm not, nothing pops to my head like usually. Usually I have a fairly quick answer, but that one doesn't. Okay, so we're kind of like 3.5 hours in here. That's about what I thought would take place. I got to do my show next for the evening, so I should probably turn my attention to that. Uh, Saturday is same time, 4 o'clock Eastern time, and I think there's two questions that I need to follow up on. One was going to be sent to me. Chuck, would you mind sending me just a little reminder of that so that I'll chew on it, and that way I won't forget it because I have a lot going on. TAT, and I can get the support. Usually Nadia just sends them over to me if I miss them, but it's easier to just hit mine. Yeah. And then so Saturday, I'm going to try to wrap up the model. What we have left to do now is almost what you were just talking about, and that is that we have some lesser important things. I gave you the most important stuff already, and that was, what are anchor bars, what's trend, how do you measure, how do you figure out what trend is, when does it transition, all that kind of stuff, right? And then these other things that we're going to get into up here, hopefully you can see my screen, is kind of the other sorts of things like, once we know um, something is broken out, how do we figure out where it's going? How do we figure out when it stopped? And then that magnet thing that I already kind of touched on was just kind of a round out thing. So I've given you the essence of the model, and I know it was fast and furious, and really I hope you all stick around, and I do hope all of you end up applying to be in the mentorship program. By the time you apply, you have to stick around for like 6 months, and of course, y'all be here that long. But I hope you keep interest, and if you do, in applying 6 months, we'll have probably at that time we'll have 4 or 5 people teaching, so we'll be able to take on more folks. Because we're, once I feel somebody really understands it, and right now there's 2 people. One of them really understands, the other one's just about there. then they'll be ready to actually teach somebody else. Okay, so I will pick up on Saturday. Send me those emails, and then I'll let it go at that. And thanks for joining me.